What's going on, option investors? My name's Henry, and if you're new, I'm continuing a series on options because that's my area of expertise when I was working at Goldman Sachs. And in this video, I'm going to explain to you guys a strategy that can profit in all sorts of market environments. This is also a fantastic strategy for taking advantage of volatility and profiting off of market movements. So while everyone else is panicking or selling, you're making money regardless. This is a strategy that's perfect for flat markets, but also volatile markets that end up hurting many investors, but at the end of the week or at the end of the month, they actually end up moving almost nowhere. And I know you have experienced those type of markets, so this strategy is for you. I want to show you loyal subscribers how to make money in any market, because if you can make money in a tough market like that, then the sky is the limit for you. So this strategy is selling iron condors. The beauty of this strategy is it takes so little capital to have a massive return. As you will see later in this video, I will do some trading. You will see exactly how I make 15, 20%, and even 25% on an iron condor trade, and they're actually not as risky as you may think. My students and I are able to make these type of returns on a consistent basis, and the reason I love selling iron condors so much is because you take advantage of the time value of options. Now, options naturally decay, and this decay is called theta. Theta is the money that goes into your pocket like a magnet when you sell options that are approaching their expiration. Especially when you sell iron condors, because as I will explain to you shortly, the full process from start to finish, iron condors sell both sides of calls and puts of a stock. Therefore, you collect double the premium from both sides. I also love that with iron condors, you control exactly how much money you make. You know exactly what level of risk you come in with and the level of reward up front. Now that you guys have a basic understanding of why I like iron condors and what they can do for you, let me go over some live examples and give you guys a full explanation from A to Z on exactly how you can open up an iron condor and you can use this strategy to your advantage. The iron condor puts probability, option time premium selling, and implied volatility on the trader's side. The iron condor option strategy is one of the best ways for an option trader to profit from an insignificant move in the price of their underlying asset. Many traders believe that a significant move upward or downward is needed for them to make a profit, but that is simply just not true. Iron condors make money in sideways and volatile markets so long as the stock doesn't run up a huge amount, like say 20% in the time period, which may be 1 or 2 weeks. So 20% would not be likely. But even when that happens, your winners will far outweigh your losers, so you will end up with long-term profits. All right, now let's jump into my screen and talk about exactly how we can make some money off this. All right, guys, we're gonna be taking a look at my screen right now. I'm going to be showing you a real life example of an iron condor on Amazon. Now, I had a heavy debate between using Amazon, Apple, or a different stock, but I chose Amazon because it's actually very interesting to play iron condors. Since Amazon is such an expensive stock, it's very difficult to really do any put selling on Amazon or any covered calls because you would need a whole lot of capital. So instead, there are other strategies that we can use without requiring so much capital, and that is an iron condor. So I'm gonna walk you through an exact example of what I would do. Now, I do want you guys to understand that it is after hours right now, so the market is not open. I'm just going to show you a hypothetical example of what I would do if the market was open, but don't worry, because you can use this type of strategy, and I'm gonna explain my full logic, my thought process, and how I think about option trading, especially in terms of an iron condor, so you can pretty much copy, mimic the same thought process, the same logic, and use it on a different stock. So it doesn't have to be Amazon. It can be any stock that you choose that you think is going to stay somewhat range bound, that's not going to explode higher. So what that means is it's very important that you do iron condors on stocks during time periods when they don't have earnings, because of course an earnings event could really shoot up a stock either upwards or downwards, which would hurt an iron condor position. So with that being said, let's go over this example with Amazon. So I'm going to go out a little bit in terms of time. Right now it is July 7th, and it is not going to be appropriate to do July 9th. That gives us absolutely no time to work with. And since an iron condor does have 4 positions, I do like to go out just a little bit farther. So I do like to teach students to do weekly option income strategies. However, what I'm going to do is with iron condors, the returns are so big, they can be over 10, 20, even 30% in a single month. I'm actually going to go out about 1 month. I would pick August 6th, but something that you guys might not know is that options historically actually expire the 3rd Friday of every single month. So without going through too much time and wasting time here, I'm not going to pick August 6th because I already know that Amazon is going to have options for August 6th, but they're not going to be as high volume. They're not going to have as good of a liquidity for August 6th. So I'm going to go for August 20. And by the way, just to prove my point, you don't see September 9th or September 8th. You see September 17th, which is the third Friday of September. Same thing for October, same thing for November, December, January. This is a very specific reason that happens. I don't know the history itself, but when I was working on Wall Street, an option trader told me that. So instead of going for August 6th, I know it's not going to have the best liquidity. We are going to click August 20th, guys. And I just want to say, stick with me if it doesn't make complete sense. After I pick all 4 different options to create the Iron Condor, I will have a visual for you guys on the side here in Robinhood. That's a new feature that they have. So I will explain to you a visual feature. So do not worry if you don't fully understand, first of all. Okay, so the first thing to do when opening up an Iron Condor is we're going to be having 4 different legs. So what happens is you sell a put option, okay? So for example, we're gonna be selling a put option. I'm just gonna go step by step with you guys, okay? Step by step and give you an exact explanation. So currently, the stock price is at $3,696. Okay, so what I'm going to do is I'm actually going to open up an Iron Condor for about $500. We're gonna see it might be 1,000. I have to do some analysis on what is the best option here, but it's probably going to be $500 worth of risk, and we're probably going to collect a whole bunch of money. It's probably gonna be around 25% return, but that is my prediction. So let me actually do the actual picking of options. So the reason why I'm going down is because, well, first of all, we're opening up a put credit spread, and I'm going to make a whole video on put credit spreads very soon. Basically, the first thing we have to do is we have to sell a put and buy a put. Sell a put and buy a put. That's how we get started on one leg of the option, okay? So we're going to pick a put that is far out of the money. And the reason why I'm picking a put that is far out of the money is I want as little risk as possible. I do not want to get executed on the Iron Condor. I don't want it to go into the red territory, and I will show you exactly where the red territory is in a couple of minutes. So first thing I'm going to do is I'm going to pick, let's say, the 34.50 strike, and that is going to have a 24 delta. That is good because that's a fairly low delta. So here we go. I'm going to sell this put, and there we go. So now what I'm going to do, and this is very important, guys, you have to do the opposite. Now you have to buy a put that is going to be a little lower. And the reason why you do that is if you sell a put, you have a whole bunch of risk. But now if you buy a put, no matter what happens to Amazon, if Amazon goes to 0, that would totally be fine because now you are kind of covering your butt. Now you have an exit. If this option goes against you, this option will go in your favor, and it's going to close off the potential downside of $3,450 with this $3,445. And the difference, guys, is just it's $5, or in option terms, it's $500 because each option is 100 shares. So this is a $500 worth of risk, okay, guys? And because this option is closer to the money and this option is farther from the money, this option has more premium and this option has less premium. So you're selling the option that has more premium and you're buying the option that has less premium, guys. So look, now I completely closed off the trade. Now we only have a $500 worth of risk, okay? You only need $500 here. And check that out, guys. You're actually collecting $113, which may not seem like a lot, but your maximum loss is only $387. The reason why it's only $387, it's really $500, but because you're collecting $113, in actual reality, your maximum loss is only $387, which makes it even juicier than $500. So if you were to take $113 divided by 500, I'm just giving you guys the percentage return. If you double 113, that's 226, so 22.6% return. That is a 22.6% return, guys, in what is it, about 6 weeks or so. So 22.6% return is one leg. By the way, guys, we're about to sell a second leg, so we're about to collect more premium. But just from the put side of things, we are collecting $113 and our maximum loss is $387. So far, if you actually do the math, 113 divided by 387, we're gonna be around a 30% return. So this is going to be a very high return trade in 6 weeks, guys, very high. So The break even is 34.48, and the reason why it's saying 34.48 is because you guys won't lose any money at expiration until, better yet, if Amazon goes down to 34.48, because, well, unless it really touches this option, we're good. It really doesn't matter. As long as Amazon stays above 34.50, we're fine. And that's why I picked 34.50, because it is significantly below 36.96. So 34.50 is significantly below, so we're pretty safe here, okay? And the break even is basically 34.50. It's saying 34.48 because we do collect some premium, and because we collect some premium, we actually reduce the break even point just a little bit from 3,500 to 34.48. So that is one side of the equation, guys, and this is going to make a lot more sense when I open up the second leg of the Iron Condor, because this chart right here, it's going to change, it's going to look different, and I'm going to explain to you guys basically how it works, how this Iron Condor behaves during the whole process from opening it all the way to expiration. So now what we're going to do is I'm going to scroll back up to a higher price than what Amazon currently is, because this second leg, essentially, the first leg that we opened was a put credit spread. We sold a put, we bought a put. Now what we're going to do, guys, is very similar. We're going to sell a call and buy a call. Sell a call and buy a call. And the first call that we sell, that first call is going to be closer to the money because it's going to be a little bit more expensive. It's going to be a little bit more cash in your pocket. And then we're going to buy a call that's a little bit farther out of the money. Again, it's going to be $500. And because we're buying a call, we're protecting ourselves, we're closing off that trade, because if you sell a call, it's unlimited risk. But if you sell a call and then buy a call just a little bit higher, for that $500, we close off that risk. You don't have unlimited risk anymore. Now we have $500 worth of risk again. However, it gets very, very interesting, because when you do an Iron Condor, guys, only one side of the leg can happen. Only the put side of things can happen, or the call side of things can happen. Think about it. Amazon can't end up hurting you on both sides at expiration. It's either going to be somewhere in between, which is very, very, very likely, or it's going to end up below or above. Therefore, even though we are risking another $500, your account will not be another $500 will not come out of your account, basically. It's going to be a total trade of 500, even though the put side of things is 500, the call side of things is 500, only one can happen. So you're still only risking 500. So although this says 387 max loss, it's gonna get better, guys. It's gonna get way, way better. And you guys are going to be astounded when you see what happens. So let's go into sell call. All right, guys, so for this second part, I'm going to show you how to open up a second leg, and that's going to be by selling the call option and then a further out call option. However, guys, I have a little bit of a tragedy here. I put in so much work into this video, but I realized that with Amazon, it doesn't have any $5 spreads anymore for the call option side of things, because it now becomes $50 spreads. So it's not going to be a perfect example. Unfortunately, Amazon is such a large stock in terms of its price that $500 spreads are just too little. Actually, most investors are going to need to risk maybe $1,000 or even $5,000. So this strategy is fantastic for stocks that are between $100 to $200. And actually, I'm going to show you guys a trade on Facebook real quick. So I'm actually going to show you the full Iron Condor on Facebook, but this time it's going to be a little bit different. But I do apologize. I'm going to do the same thing. I'm just going to show you guys an example. So we're going to sell a put just like we did before. Now we're going to buy a put just like we did before. Here, the trade is 125 and the risk is 375. Very, very, very similar to Amazon. However, this time we're going to have more luck with Facebook, because Facebook is a stock between the $20 to $800 range. So yes, we have options that look good. Thank you so much, because I put in a lot of work to educate you guys, and I thought that this video was going to just go to the trash. So no, we're going to sell, for example, the 425. Now we're going to buy the 420. What you guys will notice here is that we actually have collected more premium, and now our max loss has gone down. And that's because we're selling both sides of the Iron Condor, or essentially the put credit spread and the call credit spread. So now we have collected an extra $13 here for Facebook on the 425, 430 425, 430 is way far away from the current price. And actually, we can probably dial in the risk more and have a higher return if we go closer to 400. So let's say we sell the 400 instead and we buy the 405. And again, we're closing off our risk from 400 to 405. We only have $500 worth of risk. Take a look at that, guys. We now collect $164 and we're only risking $336. So basically we have a 50% profit because half of 336 is right around the 168. It's right around 168 or 163. So we have an exactly 50% return, guys, up until August 20. So in 6 weeks, you can make 50% return as long as Facebook stays within this range right here. So basically, if it stays between the range of our break even of 325 on the downside, again, we sold 325. So at 325, we start to lose money because one side of the leg starts to go into the red. This is what I mean by the red. You can lose up to $336. On the call side of things, again, our break even is around $401. And the reason for that is because, well, you know, we start losing money around 400, but because we collected $164, our real break even for this iron condor will be right around $401.64. So as long as Facebook stays between this range, right now it's $350. As long as it stays between, you know, 325-ish to 401, you have a profit on your hands, and that is very likely to happen. As long as Facebook is trading within this range right here in the green, you're going to be in the green. And most of the time, this is a very successful trade because both times when this option would start to lose money is when Facebook would have a very fast and adverse move to the downside or a very fast momentum move to the upside. So as long as we're in this range, this is exactly where you want to be. This is when your iron condor will be profitable. Very important final details about iron condors before you try them. The logic behind employing the iron condor option strategy is to capitalize on theta decay while expressing a neutral outlook on the underlying stock. You don't have to be completely neutral on the stock. However, you want to make sure that the stock doesn't have any big earnings events or doesn't have any big events coming up, so the stock doesn't run up 20% on you or it doesn't crash 20% on you. Theta decay for iron condors is highly favorable. Typically, one side of the iron condor will depreciate much faster than the other side due to changes in the price of the underlying asset. When one side depreciates to the point where it's worth less than $5 to buy back, I will often buy back one side and I will open up a similar position so I can collect more premium. Commissions and fees are the biggest thing to be aware of when trading iron condors. At a minimum, you will be trading for option contracts. Therefore, if you trade in a commission platform, make sure you're collecting at least $20 or $25 per iron condor. That way the fees won't really add up to as much of a percentage of your total premium collected as they would if you were to sell maybe $10 worth. Iron condors are one of my top strategies that I deploy for high returns, and I teach my students to grow small accounts using iron condors. If you want to learn how to produce weekly income and create cash flow consistently and safely without taking a lot of risk, I have some free training in the link below. Definitely check it out if you want help and guidance from me personally. My weekly Option Income Academy goes over all of this type of stuff, including option calls, picks and plays in real time, breaking down my thought process during market hours, and you will also get very hands-on access with me, as well as my team of 6- and 7-figure coaches. Click the application link below to see if you qualify. And as always, guys, be aggressive in learning, but be safe in investing.